Yes, students, we have come again. Today we'll be looking at ACC 201, which is actually accounting, okay? Accounting 201, which is an introductory course to accounting. Now, generally, I've seen what you people have done. I'll be talking about some of the documents which are required to start up a business, In a company, in the management setup, we have the purchasing department, the sales department. So we are going to focus a little bit on the purchasing department. Now, when you want to start a business, you need to make contacts to be able to get suppliers who are dealing with those kind of goods in which you are actually going to be selling. So, to get those suppliers, you prepare what is called a letter of inquiry, okay? A letter of inquiry. This letter of inquiry is a document that is being prepared and sent to suppliers to ask for the kind of good they are selling, the price at which they are selling the goods, the terms of trade, the condition for payment, and everything is being stated in the inquiry. That's the customer who wants to buy from the supplier asking questions about every terms of trade and the condition which the supplier is selling the goods. Now, after you have made a letter of inquiry and sent to the suppliers, the supplier will reply you and you make a letter of inquiry. It depends on the purchase requisition that you receive from the stores, okay? From the stores. The stores is the area in which the goods are being used. Sometimes they call it the user department. So we say that when the store is lacking materials, it will prepare a purchase requisition and send to the purchasing department. Now, when the purchasing department receives the product, the requisition that you are requesting for goods, they are going to now prepare what we call letter of inquiry and send to the suppliers that they do to ask for the availability of the goods which you are demanding for. Now, after you ask the question, they are going to reply you what we call a letter of quotation. Now, a letter of quotation is just a reply of all the questions you have been asking in a letter of inquiry. Now, after that, we go to what we call you place an order. An order. You place an order. Now, an order will be since they have replied you from the many suppliers that you have sent this inquiry to, because you want to compare the prices to buy at a cheaper price, you're going to now place an order. And once you place an order, the quantity and so on, they are now going to prepare what? An invoice. Okay, they are going to prepare what we call an invoice. Now, the invoice, before we even prepare the invoice, we have what is called a good receipt note. But that is going to come when we want to actually look at the other processes. So let's look at the invoice. The invoice now is going to be prepared based on what you have ordered, on the quantity and so on, to calculate the total amount, the net amount that you're going to pay. Now, once the invoice is being established, it has the name of the supplier, name of the customer, and so on. I will not be talking about the documents. So we now go to some cases. Before the invoice is being prepared, we have what is called a pro forma invoice. Okay, a pro forma invoice. And this pro forma invoice is usually used when a customer or a supplier is dealing with a customer for the first time. It means that he does not trust the worthiness of that customer, that he can give his goods and payment is being made. So he draft that document called a pro forma invoice, and then he sends the document first to the customer based on the agreement which they are going to have on this pro forma invoice to make payment on a particular date before the goods are going to be dispatched for delivery. So when this pro forma invoice is mostly sent when you're dealing with a customer, remember, for the first time. So with that being said and done, we are going to now look at some other areas which we'll be talking most about, which concerns the calculation. So we said we are going to be looking at some calculations which we'll see now, like an invoice. Okay, I see a question here about an example. An example we talk about on the 14th of February 2016, Azu sold goods to Prima. Azu is a supplier and he sells goods to the customer named Prima, worth 3 million francs. The total amount which you sell the good is usually called the gross amount. Okay, so you mean that the gross amount in this question is 3 million. Now, we continue by saying that the sales had the following conditions. You know, when you sell goods and services, they are being taxed by the VAT, the VAT, value added tax, which is a consumption tax on goods and services. And we have the rebates. We have rebates. Now, if I may add, what is rebate? We say rebate is a discount that is granted to customer when they supply for non-conformity of goods. Means you can place an order for LG phones and they supply you with Samsung. You see, they have given you wrong trademark, wrong brand name of the product. So it's the customer's right to return the goods, but because the supplier wants you to retain the goods, they are going to give you a discount, and that we call that discount rebates when goods do not conform with demand. So this discount here is calculated at a rate of 7.5%. So we are going to calculate 7.5% of 3 million, and I think we are going to have 225,000. 225,000. Remember that discount is this one is given is different from the other discount. But normally any discount is a reduction from the amount which is supposed to be paid. So we subtract this amount, and we are going to have a 2,725,000 as the amount. This amount does not have any name, okay? So you leave the amount there. After that, but I see in your notes they call it the first commercial net, but normally, practically, this amount does not have any name, okay? Because commercial net only start coming from trade discount. So we go to the next condition, trade discount. We have a trade discount of 5%. So you calculate a trade discount on the balance, not on the amount, because this is the amount that you have to pay now. So if they give you a trade discount of 5%, you calculate it on 2,725,000. I'll give you 138,750. You subtract again, and you have the second commercial net. The second commercial net. And you have the amount which is going to be 2,636,250. Okay. Now we go now to the next, which is called the cash discount. Remember what is trade discount issued to customer? Trade discount is issued to customer as a result of buying in bulk, okay, buying in large quantity. That's why they give trade discount. And cash discount is given to a customer for making prompt payment. That is why we give cash discount. So if they give cash discount here of 5%, so we calculate 5% of the second commercial net. So that's going to be 131,813. And we subtract again to get what we call the financial net. The financial net. And this financial net is going to be 2,504,437. After that, we are told that these goods are liable to VAT, okay? So we are going to introduce VAT. All of these are called deductions in an invoice or reduction, but VAT, you who is buying the goods, you are the final consumer, bears the burden of the tax. So we're going to have at the rate of 19.25%, and they will calculate the 19.25% on the financial nets. And we are going to have 482,104. And then after that, VAT is an addition in an invoice, because this is the amount you're supposed to pay the supplier. But because this amount is going to go to the government, if the supplier does not collect this amount from the customer, he will need to remove this amount from his own money which he will receive for the goods. So you need to add the amount to the amount which you're going to receive for your goods. So that when you receive it, this amount is going to be paid in the state account, in account 44, and this one will be on the credit side or on the customer's account, meaning you're expecting to receive the money from the customer. And then when we add these two amounts, we call it the net amount payable. The net amount payable. And this is going to be 2,966,000, 2,986,541. So with this, we are now going to move into the recording. So we are told that cost of goods sold is 75% of sales. You're even lucky that they even gave you the percentage here. Sometimes they give you markup and margin to be able to come out with a percentage to record the stock of goods. So here we are going to see how it is being recorded, okay? Because this is the most important part now. Now with the recording that I see here that is being passed in the books, you need to calculate the cost of goods sold, okay? The cost of goods sold is equal to 75%, okay? We are told that it is 75% of the sales value. Now the amount that we sold the good is 3 million, okay? So you calculate 0.75, that's 75%, times 3 million. This is the amount we sold the goods, not the amount you were supposed to pay. So this amount is without discount. So this is the amount which you calculate the cost of goods. If you calculate 75% of this, you have 2 million. 2,250,000. So this is the amount we are going to take stock for, okay? We are going to take stock on this amount, not on the amount with discount. Now we go to the recording. We'll start with in the books of Azu. Who is Azu? Books of Azu. Remember, Azu is the person who sold to Prima. It therefore means that Azu here is the supplier. And now to record in the supplier's book, I've told people that the principle of recording accounting entries is that you need to first of all know the entries you debit and the entries you will credit, okay? So it therefore means that if we have a journal like this in the other accounting, okay, the first thing you need to put here is the date, and I see the date 14th of February 2016, and you need to record. Now if you sell good to a customer, the first thing is we'll debit what you're receiving and you credit what you're giving. Now look at this. Sold good to customer. If you sell good to a customer, who is receiving the goods? Of course it's a customer, right? So it means that you need to debit account 411, which is customer. Okay? And then what are you giving out? You're giving out the goods, right? And how can you explain how you're giving out the goods? Through the aspect of you selling the goods. So you need to credit account 701, which is sales of goods. Okay? What is next? What is next is this sales of goods. The amount you have sold the good, is it the only amount you're going to pay? No, of course, right? You're also going to pay the amount of because we need to charge all the amount you pay to the account of the customer. Okay? So it therefore means that we are going to take credit account 4431, so that the total amount you have sold the good with the VAT is going to be paid by the customer. So we'll credit the VAT. This one state VAT or VAT recoverable. Now this one is VAT collected, VAT invoice. Okay? And the sales of goods, remember, is always recorded with the commercial net. That's why I told people that don't ever, if you use first commercial net, second commercial net, always use the last commercial net to record the value. And if you look at the question there, our commercial net was 2,636,250. So this should always be recorded with the commercial net. Don't forget. And then we come now to the VAT. The VAT was calculated and had 482,104. And then we go now to the customer, okay? Now if you add this to the customer amount, this amount which you're recording the customer is called the net amount payable. The net amount payable. That's the last amount on the invoice. And yeah, is the total amount which the customer is supposed to pay. You're going to have 2,986,541. And then you discover that if you add the credit side, it will not match up with the debit side. You know why? It is simple, because you have taken the total amount which the customer is supposed to pay for the goods and the VAT. But if you add it, you will not give this amount. I will not give this amount. Why? Because we are giving discount. Remember, in other accounting, we say that we do not record trade discount. We record only cash discount. So it therefore means that you're going to, because the debit side according to the double entry principle must be equal to the credit side, you need to, when you have these two amount you add is not equal to the, mean there's something you need to record on the debit side for the two side to match. Okay, so you're going to debit here account 673, which is discount granted. Okay, you granted a discount to the customer. Discount granted, and which the amount there I see is 131,813. Remember, this is the cash discount, not the trade discount. And what will be your narration? Your narration could just be sales of goods. Okay, sales of goods. And that is the entries. So this is just the entries in the books of Azu, and we are not yet done, because normally what I see in your tutorial sheet here is that or in your book is that you actually pass the entries of the oh my god, you actually pass the entries of the stock showing how the stock is going out, and then before you give the sale. It is correct, okay? So I'm explaining this. Normally I was supposed to start with the entries of the stock, but I'll just do it now. But know that you're supposed to record it the way it's given here, okay? Why? It's because before you sell the goods, you need to pass the entries recording the exit of the stock from the warehouse. So you need to record a transaction first of all from the exit of the stock in the warehouse, and then you now give the sales. Means that you have removed the goods from the warehouse when you pass that entry. And remember, this is called the perpetual inventory of recording transactions. So for you, normally when you're buying goods, you debit account 311 and you credit account 6031. This is called stock of goods, and this is called variation of stock, with the corresponding amount of the cost of goods, which is the amount you bought the goods, 2,250,000. And your narration here is because you're selling will be exit of stock. Okay, so this is the first entry we're supposed to pass before we go to the other entry. So you see, we'll record this one first because you're exiting the stock, then now you record the sales. But now when we go to the other person's book, who is the customer, he doesn't need to pass the entry, right? He will pass the entry of the stock, but his own stock that will be recording the entry will be different. He will not record at this amount because that's not his own cost of the goods. He bought the goods. So if we are going to the customer, how will we record? We will record the purchases first because he needs to buy the goods before he will come, before you send them into the warehouse. So you need to record the purchases first before you record the entry of stock into the warehouse. So in this case, we are going to have the journal here. Now we are in Prima's book. Prima is the customer and he's buying. Okay, so when Prima is buying, this is the 14th of February 2016. Okay, when Prima is buying, Prima is going to be receiving the goods, right? When you buy goods, you receive the goods, you the customer. So it therefore means that in this case, we are going to debit account 601, which is purchase of goods, showing that Prima has bought the goods. Okay, and then what are we supposed to credit? Who gave Prima the goods? Because they did not tell us here that he paid by cash. And when he does not pay by cash, they don't tell you pay by cash, business on credit. And so if he bought the goods on credit, who gave him the goods? Of course, the supplier. So it means we need to credit account 401, right? Which represents a supplier. And you can put his name in bracket, Prima, Azu, no problem. Now, 601 and 701 are always recorded at the commercial net. So if you look at commercial net there, we have 2,636,250. And then we look at supplier 401. This one is always recorded at the net amount payable. Okay, the net amount payable, the supplier account is only recorded at the net amount payable. So the net amount payable, there is a final amount which is supposed to be paid to the supplier by the customer. So it means this is the amount that the supplier will be expecting. So you need to pay this amount to the supplier. So the amount there, the net amount payable is 2,986,000. 541. And then now we need to charge also the VAT, because you will not pay only this amount, right? Remember, this amount is only the commercial net. Okay, so if we record only the commercial, after the commercial net you have financial, before the financial net you give a discount that reduces this amount. So if we leave it like this, the credit side will not match with the debit. So we need to record a VAT account 4451 or 54, account 445, no problem. Here we are going to have VAT recoverable. VAT recoverable. You're recovering the VAT from the purchases. Okay, when you buy, you will recover the VAT back from the state. So the amount is 482,104. Okay, so here now, if you add the debit side, it will not be equal to the credit again. Why? Because when this customer was buying, we gave him a discount, which is called cash discount. And so if you look at this amount which they are paying here, it will not be equal to the sum of this. So we need to, on the credit side, we need to debit or credit the amount of the discount to reduce the amount which is supposed to be paid by the supplier. Remember, the credit side must be equal to the debit side. So we are going to credit account 773, which this is called discount. Is discount, yes, but there's a name they usually call it. We call it a discount receipt, no problem, because it's the customer we are recording. The customer is receiving the discount. The other one is the supplier giving total discount granted. So a discount receipt, we have 181,813. So our narration here will be, normally we'll just give it our narration here will give it to be a purchase of goods. You can just say purchase of goods. or you can say yeah, purchase of goods. Since the other one was sales of goods, just say purchase of goods. But where the document number is given, okay, if the source document number, remember I'm just putting this purchase in. Remember when you begin the narration, you have to be bin purchase of goods in the past tense. So if you have the invoice number, for example, invoice number 2201, your narration should just be the invoice number. No need to put any narration there. So we go now to the next. We are going to be talking about DODs, means the same date, okay? So we are going to be looking at the recording now. Okay, we have bought more stock. The customer has bought stock. What will happen to his warehouse? Of course, his stock will increase, right? So if his stock increases, you need to debit account 311 because stock of goods now in the warehouse is going to increase. So you debit account 311 stock of goods with the amount that he incurred as a cost, and you credit account 6031 because the stock will change. This is called variation of stock. With the amount of his cost of good. Now, what is the amount he's going to be considered as the cost of good? The amount which is going to be considered here as the stock, the cost of the goods for the customer is going to be the commercial net. Because the commercial net is the amount which he's going to spend. Okay? And because he was given trade discount, we record a discount already here. So we cannot record a discount again in the stock which is sending to the warehouse. So you record this stock amount in the customer's book at the commercial net. The two amount at the commercial net. And the amount there was 263,000 or 2,636,250. 2,636,250. Okay? And here we'll have it as entry of stock because he bought more stock since he's the customer. And that's the entry which we are going to pass in the books.